Hi there folks, thought it was about time I got the old jacket out, dusted it all down. Now for those of you that don't know who I am, basically I started my trading career over 35 years ago. I worked in the City of London in the trading pits. That's the open outcry trading environment, shouting and screaming, yelling orders at each other throughout the trading day. We were literally throwing around hundreds of thousands of dollars on a daily basis. Now, when you're on the trading floor, you could work for a bank, as this was Swiss Bank, or you can work for yourself. That would be normally a red jacket. I've got the red jackets there as well. That's basically when you fund the account yourself. But whatever way you wanted to work, it all basically was trading. Trading in those days was very different than where it is today, when we're sitting there on our screens with a mouse clicking away as it goes. Now, of course, at the turn of the century, all these trading floors, these were closing down around the world, and everyone's basically trading from their screens in their offices or in their home. And I think personally, trading in the trading pits was actually easier than it is today. But why do I say that? Well, I say that for the simple reason is, in the trading pit, you basically had all the other traders out there watching what you were doing. You can't hide behind your screens as we do now in your own personal world of turmoil. Just you, the screen and the mouse, easily blowing up trading accounts as you go. I can tell you something. If you were on the path to blowing up your trading account on the trading floor, everyone was knowing about it and everyone was basically smirking about it. So it basically gave you a very good reason not to embarrass yourself and get laughed off the trading floor. So it was much easier, I think, in those days, because you had that sort of discipline almost put into you because of the fear of losing face. But one thing is very common between the trading pits and the trading screens that we have today, and that the mindset should be the same. You should be thinking in terms of probabilities. Now, if you're on the trading floor and you're to have a certain amount of losing trades, well, the last thing you want to do is revenge trade and start gambling up and chasing your losing trades, because everyone would see. You have to think in probabilities. If you have losing trades, you get on, you dust yourself down, you carry on, you have your winning trades, you have your losing trades, it all comes out in the wash. And this is what you should be doing here on the screens. And I think it's the number one reason why many traders fail when they start off trading, is that they don't think in terms of probability. They're thinking in terms of that one trade. That's why you see them out sometimes with their phones checking their trades when they're out and about doing their daily chores, because all their emphasis is on the one trade. And quite frankly, that's just wrong, and you shouldn't be thinking about one trade on a standalone. You should be thinking about them in conjunction of the others. And that's basically how probability plays out. Probability exists in all walks of life. A common example you may be more familiar with would say be life insurance. Think about that. You are 50 years old or so, you want to get life insurance, you go to the insurance company and all the details go into the magic machine and out comes a premium. Now let's assume you're a healthy looking chap like myself. You don't smoke, might have a couple of beers now and again, but otherwise you're generally healthy, and they put a price on your life. Now they're not basing it personally on you, they're putting all that data into a big pool of other people just like you to work out the probability basically of you dying. Now, if I was to keel over tomorrow from a whole heart attack, hopefully it doesn't happen, of course, no more YouTube videos if that happens, of course, but if that were to happen, the insurance company is not going to throw out the whole of these life insurance policies because I was just one number. What the life insurance company is doing is looking at me in the whole big picture. They've done their numbers. I am just a small sample in the big picture. Probabilities work in all facets of business, and it is no more so than in the trading markets. Think about this for a moment. This is an equity curve. Well, it will be in a moment. You've got the time along the bottom and you've got your profit on the vertical axis there. So this is a profitable trading strategy, yeah? Okay, this is your equity curve. Okay, as any healthy equity curve will look like, it has its drawdown periods. So are you throwing out perfectly good trading strategies when you have that period there, or that period there, or that period there. That's just part and parcel of what we do. It's all about probability. We have our winning trades and we have our losing trades. And the obvious example of this, and I really want you to go away and potentially do this, is the good old coin toss. We often hear the good old coin toss theory when it comes to trading, but it's a very good way of describing probability. Now, we all know that for an evenly weighted coin, heads over tails, it should be 50-50, yeah? Now, chances are, if you were to do, say, 10 tosses, yeah, top line, you should get 5 and 5. Doesn't necessarily mean you will get 5 and 5. You might get 7 and 3, you might get 8 and 2, you might even get 10 to 0. Here, I've tossed the coin. It shows how bored I was yesterday, tossing the coin 100 times. As luck would have it, this is a 50-50 outcome. There were 50 heads to 50 tails over 100 tosses. That won't always happen. Pretty close if you toss it 1,000 times. I wasn't that bored. So 50 on 100 tosses. And I recorded them as we go here. So I thought this isn't going to be a very good example to start with, because we had 5 and 5, then we had 4 and 6. And you can see how the splits go, tails over heads, tails obviously with a T, and H is the heads. But what's important here, and I want you to look at, is the sequence, the random distribution of that edge. Look here. Here you've got 1, 2, 3, 4, 5, 6 tails on the bounce. Imagine having a trading strategy. Start off trading, you've just bought it off online somewhere, or you've developed your own, or you followed one of mine, for example. You start trading, bang, you have 6 losing heads, losing trades, tails, comes out. You're going to throw that out, yeah? That's an absolute rubbish strategy. But then it averages out, you have 3 heads, another tail, then you have tail heads, and then a couple more coming in. It's basically averaging out over time. Okay, here you've got, what do you got here? You've got 1, 2, 3, 4, 5, 6, 7 tails. Again, 7 losing trades. But the overall outcome was still 50-50. And you should be thinking about that with your trades. Some will win, some will lose. Now, of course, clearly, we want our trading strategy to have an edge. A simple edge is all we need. Think about the casino, the roulette wheel, yeah? You have numbers 1 to 36 plus the green 0 at the top. But if you place your chip on red 32 and it comes in, you're only going to get 36 to 1. But you've got that 0 at the top. Actually only going to come in 1 in 37 spins in terms of probability. That's the house's edge. That's the casino's edge. Very minute, but it's spinning that wheel every 20 seconds or so. So the law of large numbers comes into play. The casino owner, he's not worried if red 32 comes in 4 times on the bounce, because he knows over the course of the evening, the course of the week, it will even out. And that's exactly how we should consider our trading. Think about it in terms of probability. The slightest edge, let it play out over time. I'm a trend follower, for example. I like to get into trends. You look at the higher time frame analysis, their weekly is up, the daily is up, 4 hour, I'm only buying. You can use moving averages or which way you want to determine your trend. I'm only buying. I buy on a pullback, simple set of rules. But I'm not going to trade through resistance. What you're doing there with three very simple rules is created an edge that should play out over time. But hey, what do I know? Why don't you just go away now and backtest that theory with a very simple edge in a trend and see how it works over 100 trades. There is a challenge in itself. Most people will give up after 5 to 10 goes, certainly if you start losing. Do it 100 times on a demo account and let me know how you got on. I'll be checking next week in the comment section to know exactly how that worked for you. Have a good week. Almost forgot, don't forget to subscribe to the channel, hit that bell notification, and of course you can follow us on all the socials as well. We are streaming live each and every day around the clock, up to 7 times a day. If you want to come over, take part, do so, take out a 7-day free trial, then you can talk to me personally. Let me know how you got on with this little probability challenge. I'll be waiting to see how it works for you. If that is not your thing, that is not a problem. I'll see you next week with the results.